Hello everyone, and here we are with yet another video of financial accounting, and that is partnership accounting. This is the first part, that is basic concepts. Well, here I am, Dr. Aarti Mudliar, Assistant Professor, Department of Commerce, the Bhopal School of Social Sciences. Well, directly jumping into the topic, first of all, I would like to tell you about the forms of organization. Because when we are studying about the partnership form of organization, we should have a clear-cut view of the various other types of organization or different forms of organization. So here we have the major forms of organization in front of us, right? The first one being sole proprietorship. Now, the sole proprietorship firm has the single owner. That is the main feature of a sole proprietorship business. Against that, there is a partnership business where two or more than two members or owners can run the same business. Whereas there is another type of business, that is company form of organization, or we may call it joint stock company. Here a lot of owners can be there of the same business, and there can be a large number of pooling of capital. And it has a lot of advantages over the other forms of organization. Now, let us understand one by one the features of each form of organization, and especially the partnership form of organization. Well, a sole proprietorship firm has certain special features, or you may call it the characteristics. Now, once you understand the characteristics of this form of organization, hopefully you will be able to understand that why there is a need of a partnership firm. Well, every businessman would like to grow, isn't it? And the growth is the very nature of business. Now, let us understand the features of a sole proprietorship firm. The first one being single ownership. Now, here single ownership means that there will be just one owner of the business organization, and this person only is going to have all the profits or bear all the losses. That is, the risk is borne by the person, and the reward is also enjoyed by one single person. The another feature is it is one man's capital. No one else is going to contribute any fund to run this business because it is one single person. And he is going to run the entire business on his own, be it all the managerial part or the operational aspects of a business. The next feature being the unlimited liability. Do you know what is unlimited liability? Well, in case the debts are more and the assets are not sufficient to pay off those debts, then the private estate of the owner are also attached to the business, and out of his private estates, the debts of the business are paid off. This is called unlimited liability, which is the very feature of a sole proprietorship concern. The next one being there are very less formalities, or you can say compliances, to set up this form of organization. And that is why people prefer more and more of this form of organization, and they become a sole proprietor rather than the other forms of organization because of the huge compliances. The last one being it is one man control. Many a times people want that only because they want to control the business on their own, and they enjoy the fruits of the business which they derive after all the operations being performed. So, looking after these features, you must have understood that some of the features sounds as advantages, but some sounds as limitations. And my dear students, because of the limitations of a sole proprietorship firm, you can say a partnership form has emerged. That is, the limitations of the managerial and the capital aspects of a sole proprietorship firm has initiated or has pushed the need of a partnership firm. Now, let us understand one by one that why are these needs required, or you can say why do we need partnership business when we already have a sole proprietorship concern. Now, there is a one single owner. Now, this owner will have a limited capital, and he cannot invest more than that. Everybody has a limited source of funds. Now, if he wants to expand his business, money would be required, funds would be required. So what he'll do? To invest more and more in his business, he has to have a helping hand. And there comes the partnership form of organization. This idea comes into existence because he needs the support of some other person. And it is not regarding the capital only. He may require assistance from the other people regarding many other aspects. You want to know what are those aspects? Let us understand what can be the various aspects because of which a partnership form of organization can be adopted. Well, a partnership business is one single business having two or more than two owners. So we must be very, very clear about this, that just one business, the same business is going to be run by two or more individuals as owners. That means they will have the proprietary right of that business and they are going to share the profits or loss arising out of this business. And that is why we need to know that what all are the specific needs of this form of organization. Number one being, a person may have sufficient funds, but he may not have the skills to run the business. Now let us take an example. Suppose Mr. A and Mr. B are there. Mr. A is a sole proprietor and he is running his business maybe of say garments. Now he wants to diversify his business and he wants to enter into the production of say bags. But he doesn't have the skills to manufacture bags, which Mr. B knows very well. So here comes the requirement of skill which this sole proprietor doesn't have. And therefore he may join hands with Mr. B and acquire his skills and scale up his business. Another reason can be that he may have the skills just the opposite of the previous one, but he doesn't have sufficient funds. Now, requirement of funds will always be there in the business and every person has a limitation for the funds. And therefore, he may call upon the other person as a partner to join his own business and bring in capital. And for the need of more and more of capital, we require a partnership form of organization. Another reason can be sharing the risk, because in any kind of business there will be risk of losses, and if more and more of people are there, we can share the risk. So therefore this partnership form of organization is definitely advantageous over the sole proprietorship form. Now, well, my dear students, let us understand the definition of partnership. Well, let me tell you that Indian Partnership Act 1932 is well in place to govern all the partnership form of organization. Now, Section 4 of this Act defines a partnership as the relationship between partners who have agreed to share the firm's profits carried on by all or any one of them acting for all. Now, these are the specific terms which has to be kept in mind when you are understanding the definition of partnership firm. Alright, so because of that, I have put all these important terms in bullet points. Let us understand them one by one. The first one being, partners share their profits of the firm amongst each other. And therefore, the important thing to be understood is the sharing of profit. Whenever the profits are earned, in a sole proprietorship firm, the entire profit was kept by the single owner. And if you remember, in final accounts of a sole proprietorship firm, we used to add the entire net profit in the balance sheet in the capital itself. But since here are more than one, or you can say more than two owners, and therefore there is a need to share the profit among them in the agreed ratio. The second point is, the firm's business must be carried on either by all or any one of them acting for all. Now, what does it mean? It is not necessary in a partnership firm that all the members has to be actively involved in the operations of the business. Even a single person can handle all the operations of the business and the rest may sit aside, or maybe everyone can look after some or the other work of the partnership firm. Some can be simply sleeping partner. Sleeping partner means those partners who are not actively involved in the operations of the business. But that doesn't mean that they would not share the profits. Of course, there can be some partners who may not be the party for the losses. We'll study about it later. Now, the last and very important thing is all the partners, the persons are individually called partners, but collectively, that is together, they are called firm. And that is why it is called partnership firm. I hope you have understood these main points which have been derived from the definition given in the Partnership Act 1932. Moving further to the features of partnership. Now, the Act does not give all the features of a partnership firm. Just now we had learned the features of a sole proprietorship firm. Let us also understand the features of a partnership firm. The very first being agreement. The entire partnership depends on the agreement. Even if two friends are coming together, they would agree on certain terms and conditions. And where there is a business, there has to be agreement or consensus on certain points, so that in future the disputes doesn't arise. These agreements, the points which has been discussed upon among the partners and they have agreed upon it, can be in the written form or it can be oral. It is not necessary that it has to be documented. But of course, if it is documented, then it is beneficial for the partners to settle off their disputes or maybe for a better understanding to run their business. The second one being there has to be a business. Now, what does it mean? It means that the Act doesn't include that any person are coming together simply for charitable purpose. That means they have to carry on the business or profession for the purpose of earning profit. Yes, the business has the main objective of earning profits, and that is what is covered under Companies Act. Under Partnership Act. The next feature being profit sharing. Well, as I said earlier, that when there are more than two owners of a single business, the profit has to be divided among them. Now, how it will be divided? That has to be decided in the agreement itself. It can be divided equally. It can be divided in a certain ratio, maybe 3:2:1. It can be divided maybe as 2:2:1. It also can be divided in the ratio of the capital contributed by each of them. And all these depends upon the agreement of the partner, the mutual agreement of the partners. They all have to come to a single point of consensus, and then only the business will go on smoothly. The last feature being the principal and agency function or the relationship. It is also called mutual agency function. Now, what does it mean? It means that each and every member, or you can say each and every partner of a firm, is an agent of the other partner and also the principal of the other partner. This means that any act performed by any of the partner is mutually, the other partner would be responsible for any of the act enacted by any of the partner. So the responsibility of each person's performance is falling on the other people as well. So every partner is a principal as well as agent of the other partners. This is what mutual agency or principal agency relationship means. Let us learn a few more things about the Partnership Act 1932. Well, this act governs all the forms of partnership organizations across India. The second thing being that it contains all the provisions defining the rights, the duties, liabilities and powers of partners. That means the Act clearly states what is to be done by the partners and what is not to be done by the partners. But these provisions are not always binding on the partners minded. Why? Because in the very next point they are saying that they are free to bind themselves with contrary. Now, what does this contrary provisions means? It means that it is not necessary that whatever is given in the Act has to be followed by the partners or the firm. They can have with their own agreement some other provisions to run their own business, and such provisions will prevail. I repeat, it is not necessary that the provisions given in the Act only are to be followed by the partners. If the partners have agreed to any contrary provisions means the provisions that are not given in the Act. If they are following any of such provisions and it has been mentioned in their agreement, it will prevail. They will bind to those provisions and the Act will also agree to such provisions. And that is why in case of disputes, the Partnership Act governs and settles such disputes. Now, what happens if there is no partnership deed? And before that, we must know what is partnership deed. Well, the agreement which has been documented or which has been in the written form, it has been written and agreed upon by the partners is termed as partnership deed. So therefore, they will agree upon various points. How much will be their capital? We'll see what is the format, the tentative format of partnership deed also we'll understand. And before that, let me tell you, it is simply a written document or a written agreement upon which the partners would operate or run their business. Well, just now we had talked about the provisions contained in the Partnership Act 1932 and the provisions contrary to it. Now, if there are certain contrary provisions, those provisions must be documented in the form of partnership deed. So therefore, partnership deed is simply an agreement, put it in the written form. Okay, if all the partners have agreed upon certain terms and conditions and they have documented it, it is termed as partnership deed. It may explain the rights and duties, nature of the firm, name of the partners, and just now we are going to see what all can be contained in a partnership deed. And here we have the partnership deed in front of us. These are, I cannot say that there is a prescribed format of partnership deed because this is customized by the partners and every partnership firm may have their own different deed. But these are some of the common points which will be present in most of the partnership deeds. Let's go through it one by one. The first being the name of the firm. It has to be, of course, there whether registered or not. Now, the second important thing is the name and details of all the partners, that is their residential address and all the other details. Then, the date of commencement of the business is very important, that when the business has started operating. Then, the duration of the business or the firm's existence. Sometimes, some of the firms may exist for a specified period of time. It may not last forever. And if such a defined time period is there, it has to be written in the deed. The next point is the capital contribution by each of the partner. Well, every partner would like to get a reward on their capital. And that is why it is very necessary to exactly document this amount in the partnership deed, that how much was required and how much has been contributed by each of the partner. The next thing is the profit or loss sharing ratio. And we normally call it in short form, in abbreviated form as PSR, profit sharing ratio. This is the most important thing which prevails or which exists in a partnership deed. That is the ratio in which the profit will be divided among the partners. Next thing, if they have contributed capital, then they are expecting some reward, and that reward is in the form of interest on capital. But what shall be the rate of interest on capital has to be clearly mentioned in the deed. Otherwise, every partner can claim a different rate of interest and that will raise some disputes. Further, it may also explain the extent of withdrawals done by the partners for their personal purpose. So, to what extent each partner may borrow from the firm. Okay, that is also termed as drawings. The next thing is salary payable to partners. Now, sometimes the partners, since they are owners, right, and most of the work or the operations of the business are done by these partners only. And therefore, the person who is very actively involved in all the operations of the business may demand salary just like an employee. But mind it, he is not an employee, he is a partner. And since he is a partner, any contribution or any amount given to the partner has to be mentioned in the partnership deed. Although This particular provision does not exist in the Partnership Act. And that is why I said that there can be certain things which are contrary to the provisions given in the Partnership Act. The next one being the procedure of admission or retirement of a partner. Well, there can be a change in the constitution which had never been there in a sole proprietorship concern. He was a single owner and always remained a single owner. But since there are more than two owners in the business, there may be reconstitution of the firm. And reconstitution means coming in of the partners and going out of the partners. Coming in is termed as admission of new partners, and going out is termed as either retirement or death of partners. The next one being the methods used for calculating goodwill. Well, the accounting policies that is adopted in any business is clearly mentioned in their policy document. And this is one of the policy document. So therefore, if there is need of the valuation of goodwill, that has to be clearly defined in the partnership deed. The next is the preparation of accounts of the firm. When are the books of accounts are to be maintained, what all will be the preparation of books of accounts, and where will the books of accounts be kept has to be mentioned in the deed itself. Mode of settlement of dues with a deceased partner's executor. In case of death of a partner, what will be the mode of payment? Whether it will be converted into loan, or it will be paid in cash, or will it be paid in installments along with interest, has to be clearly mentioned in the deed itself. And the last point is the procedure followed in case of disputes that are arising among the partners. What can be the procedure? How it will be settled? Everything shall be clearly mentioned, right? That whose terms and conditions will prevail in case of dispute, and how this matter will be solved, whether it will be solved in the court or out of the court. They may mention such type of things in the partnership deed. There can be some more points or there can be some lesser points in every person's or in every firm. Okay, so by now I hope that what are the different terms and conditions of a partnership firm and how they are documented in a partnership deed is absolutely clear. But ignorance can always be there. Some of the partners or the firm may sometimes ignore and will not create their partnership deed. Now, in case of dispute in such a condition where the partnership deed itself doesn't exist, what can be done? So here are the points which has to be kept in mind by the students of accounts, especially when a partnership deed doesn't exist. The first point being, in case partners do not adopt the partnership deed, the following rules would apply. The first one, profit sharing ratio would be equal. They will share all the profits and losses equally. No matter whatever the partners say. They may say that the profits be divided in the capital ratio. They may say the profits be divided in a certain specific ratio, but nothing would be done. All the profits and losses would be divided equally. Why? Because they never agreed upon the profit sharing ratio. The next one being, nobody would get any salary. This is called actually appropriation of profit. That is what we are going to learn in the next part. Now, there will not be any appropriation, that is, no salary shall be paid to the partner no matter how actively he is performing in the partnership firm. Drawings will not chargeable with interest. That means no interest on drawings shall be charged by the firm on the withdrawals done by the partners. And similarly, there will be 6% interest on loan. I missed one of the point, that is interest on capital. When there is no interest on drawing charged by the firm, that means they are not going to give away any interest on capital as well. In short, you can say that in absence of partnership deed, there will be no appropriation at all. Simply, the entire profit or loss will be divided among all the partners in equal ratio. But yes, if any partner has extended loan to the firm, then it will bear 6% interest per annum. Mind it, per annum. 6% is the rate given in the Act. and it has to be charged proportionately over the year, right? So if suppose the loan has been extended during the year, say on 1st of October, that means the interest will be given at the rate of 6% only for 6 months, not for the entire year. That is what per annum means. Alright, after understanding all the basic concepts of a partnership firm, here comes the accounting recording. Now, whenever we are talking about the accounting records of a partnership firm, let me tell you, it is more or less similar to the sole proprietorship concern. So therefore, the good news is the accounting cycle followed by a sole proprietor is exactly followed by a partnership firm as well. I would like to explain it by preparing an accounting cycle where it will begin with journal. That means the way a sole proprietorship concern prepares its journal book, in the same manner a partnership concern also will prepare its journal book and pass the journal entries. Soon after that, the classification procedure takes place, that is the preparation of ledger. The same way the ledger accounts will be prepared in a partnership concern as well. The way summarizing is done in the form of trial balance, in the same way it will be prepared in the partnership firm as well. After this trial balance has been derived, the step of preparation of financial statements come. Now, how do we prepare financial statements in a sole proprietorship concern? When we are talking about the preparation of financial statements, we are talking about two documents, you can say. The two documents are income statement and position statement. I hope all of us have learned about this. Now, what is position statement? It is nothing but balance sheet. Okay? And what is income statement? It is trading and profit and loss account. Now, so far we have already understood while the preparation of final accounts that how a trading account or a profit and loss account is prepared. What is the end result of income statement? Net profit, isn't it? We prepare this income statement to arrive at the net profit, and as soon as we get this net profit, immediately we add it to the capital which is provided to us in the balance sheet. That is, in the balance sheet, we give our position, our financial position to our financial users, that how much is our assets, how many assets do we have, what is the value of the assets we possess, and how are they funded. That is, how many of the assets have been funded by the capital and how many assets have been borrowed by external liabilities. And this net profit keeps on increasing the capital of the owner. But when we are talking about the financial statement, one more step gets added. Why? Because we have also gone one step ahead. We are talking about a partnership concern. So soon after the preparation of trading and profit and loss account, we prepare profit and loss appropriation account. Profit and loss appropriation account. And that is what we are going to learn now. Now, what does this term appropriation means and why there is a need to prepare this profit and loss appropriation account? See, in a sole proprietorship concern, as soon as we arrive at the net profit, it is added in the capital of the owner because there is one single owner only and he only enjoys the entire profit. But in a partnership concern, there are more than two owners, and therefore there is a need to appropriate this profit judiciously among them. Now, this judicially terms gives rise to the preparation of profit and loss appropriation account. And all of us know that once the profit has been judiciously or rationally distributed among the partners, it is going to give an impact on their capital. And therefore, there is a need to prepare partners' capital account, which we will learn in our next video. Let us concentrate right now on profit and loss appropriation account. Well, this is the format of profit and loss appropriation account in front of you. And let me tell you, this is nothing but an extension of profit and loss account. the way we extend the trading account and prepare profit and loss account, just the same way the profit and loss appropriation account is prepared as an extension of profit and loss account. And therefore, the way gross profit is transferred from the debit side of trading account to the credit side of profit and loss account, in the same manner, the net profit arrived at in the profit and loss account in the debit side is transferred to the credit side of profit and loss appropriation account. Okay, that means you are bringing down this net profit to be distributed among the partners. Now remember, I said judiciously or rationally. Now each and every partner will be performing some different kind of activities for the firm, for the business, for which they require certain rewards. They are expecting certain rewards proportionately. The first thing being the capital contribution. Now some of the partners may contribute capital in little amount, whereas some of the partners may contribute capital in a large amount. Just imagine, even if the rate of interest is same, the quantum of interest would be different because the amount on which the interest is being applied is different. So, the partner who has employed more capital in the firm would be getting the higher amount of interest, and the person or the partner who has contributed lesser amount of capital would be getting less amount of interest, even though the rate of interest is same. Therefore, it is a justified reward against their capital. So, out of the profit, out of the net profit, the first division or appropriation is done in the form of interest on capital. Now remember, this profit and loss account is nominal in nature. So all the expenses of the firm would be debited, no matter it is related to partners, and all the incomes of the firm would be credited. The next appropriation being salaries to partner. As I earlier said, that some of the partners can be actively involved in the business operations and they'll be expecting some salary from the profit. Now this salary is not a charge on profit. The salary which is given to the employees is a charge on profit, is a compulsory deduction, and that is why it is debited in the profit and loss account. Whereas salary payable to a partner depends that whether we have some profits or not. If we have profits, then there is a scope to give some amount as salary to the partner. But the amount of salary payable to a partner must have been mentioned in the partnership deed. Otherwise, no partner can claim salary no matter how much he is working in the firm. The next appropriation relates to the firm itself, that is creation of reserves. And this is something which every business organization would do. Even we do at our homes. We make some savings out of our total incomes. We do not simply spend everything or simply distribute it among the owners. And that is why, to strengthen the financial position of any business, it is necessary to create certain reserves and set aside to meet out certain future contingencies or losses. Now, regarding partners' commission, sometimes apart from working in the business operations, there are certain conditions like some person or some partner can use his more of connections or contacts, because of which higher amount of profits is being earned by the business, and for that possibly he may charge certain commission. Now he may claim the commission on sometimes net profit or maybe on the sales even, and that should be mentioned in the partnership deed again, that on what amount the commission is to be paid, whether it will be an aggregate amount or it will be a certain percentage of profit or turnover. There can be some withdrawals made by the partners for their personal use. Now, if the partners are withdrawing some amount from the firm for their personal use, they are liable to pay interest to the firm. Why? Because when they had contributed capital, they were asking interest on capital from the firm, and when they are withdrawing from the firm, they are liable to pay interest on drawings to the firm. It is simply, paying back whatever you are getting from the firm, you are paying back some amount against it. And since interest on drawing is income for the firm because they are getting something from the owner, it is written in the credit side, right? So I hope the journal entries are also clear to all of you if you simply look at this profit and loss appropriation account. For example, for charging interest on capital, the first entry would be interest on capital account debited to partner's capital account. And then soon after this, interest on capital is to be transferred to profit and loss account, and therefore the entry is profit and loss appropriation account debited to interest on capital. And the same way for salaries, for reserves and for commission as well, the same entry will be passed, that is profit and loss appropriation account debited to partner's salary, to reserves and to partner's commission. And just the opposite for the interest on drawings. That is, for charging interest on drawings or for claiming interest on drawings from the partners, we will pass the entry as partner's capital account debited to interest on drawings, and then we would transfer it to the profit and loss appropriation account, for which the entry would be passed as interest on drawings account debited to profit and loss appropriation account. Once these treatments are clear related to appropriation, there would be certain balance. That is, after getting interest on drawings from the partners and distributing rationally the amount of profit, if there is any balance left over, this will be divided in profit sharing ratio. And mind it, this profit sharing ratio must have been mentioned in the deed. If there is no deed, then this profit shall be divided equally. So, the remaining profit is then transferred to profit and loss from this profit and loss appropriation account to the partner's capital account or to their current account. Now, whether it will be transferred to capital account or current account depends on one condition, that the partners are maintaining their capital as a fixed capital or as a fluctuating capital. If they are adopting the fixed capital method, then it will be transferred to the current account. But if it is a fluctuating capital account, then it will be transferred to the capital account, that is to the respective partner's capital account. And that is how each of the partner will get a rational share from the profits in whatever way they are contributing to the firm, be it's money, be it's their own contribution in the form of time and energy. So this is how profit and loss appropriation account is prepared. In our next video, we will learn about the next accounting step, that is calculation of interest on capital, calculation of interest on drawings, calculation of commission and preparation of partners' capital and current account. Till then, keep safe, keep healthy.